Ever wonder how the rich seem to get richer while your savings account barely grows? There's a hidden mechanism in the global financial system, a massive invisible river of money that flows from ordinary people like you and me straight into the pockets of the world's most powerful banks and investors. It's called the global carry trade, and it's one of the biggest secrets of modern finance. It's a system designed to transfer wealth, and today we're going to pull back the curtain and show you exactly how it works, why it matters, and how it impacts your financial life every single day. So, what exactly is the carry trade? At its core, the concept is deceptively simple. Imagine you could borrow money at an incredibly low interest rate, say 1%, from one bank. Then, you turn around and lend that same money to someone else, or invest it somewhere that pays you a much higher interest rate, like 5%. The difference between the two, that 4% gap, is pure profit for you. You didn't produce anything, you didn't create any new value, you just moved money from a place where it was cheap to a place where it was expensive. Now, scale that up to billions, or even trillions of dollars. That's the carry trade. This isn't just a niche strategy for a few clever traders. It's a colossal force that shapes our entire global economy. Every single day, trillions of dollars are zipping across borders, chasing these interest rate differences. This massive flow of capital influences everything. It determines the value of your country's currency, making imports cheaper or exports more expensive. It inflates the prices of stocks, bonds, and real estate. It can even make or break entire national economies, all because giant financial institutions are playing this high-stakes game. When you look at who benefits from this system, a clear pattern emerges. The winners are the big players: global banks, massive hedge funds, multinational corporations, and the ultra-wealthy individuals who have access to cheap credit. They can borrow billions at next to nothing interest rates from central banks like the US Federal Reserve or the Bank of Japan. They then deploy this capital into higher-yielding markets around the world, like Brazil, Turkey, or emerging economies, and pocket the difference. It's a low-risk, high-reward game for them because they are borrowing money they don't own. So if they're the winners, who are the losers? It's a long list, and it probably includes you. First, ordinary savers lose. While banks are borrowing at near zero rates, you're lucky to get a fraction of a percent on your savings account. The system is literally designed to punish saving and reward borrowing. Second, taxpayers lose. When these risky carry trades go wrong, and they often do, the resulting financial crises lead to massive government bailouts. Who pays for those bailouts? You do, through your taxes. Finally, smaller economies lose. They become addicted to this flood of foreign money. But when the tide turns and the capital rushes out, their economies can collapse overnight. This creates a dangerous and predictable cycle of instability. It starts when a major central bank, like the Fed, lowers interest rates to stimulate the economy. This creates a mountain of cheap money. Banks and investors borrow this money and pour it into speculative assets all over the world, creating bubbles in stocks, real estate, and other markets. Eventually, something spooks the market. Maybe the central bank hints at raising rates, and everyone rushes for the exit at once. The carry trades unwind, the bubbles pop, and a financial crisis erupts. What happens next? Central banks and governments step in with bailouts and even lower interest rates to save the system, which, ironically, just sets the stage for the next, even bigger carry trade cycle. One of the most damaging effects of the carry trade is its role in driving global inequality. When central banks print trillions of dollars and keep interest rates low, where does that money go? It doesn't flow into higher wages for workers or into building new factories that create jobs. Instead, it flows directly into financial markets. It bids up the prices of stocks, bonds, and real estate, the very assets that are overwhelmingly owned by the wealthiest 10% of the population. So, the rich see their net worth explode, while the average person is left behind, facing higher housing costs and stagnant wages. The carry trade is a machine for widening the wealth gap. History provides undeniable proof of this destructive cycle. The 1997 Asian financial crisis was a classic example. Investors borrowed cheap Japanese yen and US dollars and invested them in high-growth Southeast Asian economies like Thailand and South Korea. When sentiment shifted, the capital fled, currencies collapsed, and these economies were devastated. Fast forward to the 2008 global financial crisis. A key driver was a carry trade where investors borrowed cheap money to invest in high-yielding but risky U.S. mortgage-backed securities. When the housing market cracked, the whole system came crashing down. Even the 2020 pandemic crash saw a massive, rapid unwinding of carry trades as investors panicked and pulled their money back to safety. Each crisis was a repeat of the same fundamental flaw. Today, the carry trade is bigger and more dangerous than ever, and its main enabler is the U.S. Federal Reserve. For over a decade, the Fed's policies of near-zero interest rates and massive money printing, known as quantitative easing, have provided the ultimate fuel for the global carry trade. It has created the largest pool of cheap US dollars in history. This has not only supercharged the traditional banks, but has also given rise to a vast shadow banking system, less regulated entities like hedge funds and private equity firms that now run some of the biggest carry trades on the planet, all outside the view of regulators. The global financial system has become utterly addicted to this cheap money. It's like a patient that can't be taken off life support. Every time a central bank, especially the Fed, has tried to normalize policy by raising interest rates, the financial markets have thrown a tantrum. Stocks plummet, credit markets freeze, and the threat of a full-blown crisis forces the central bank to retreat and turn the cheap money taps back on. We are trapped in a debt-fueled system that cannot withstand higher interest rates, ensuring the carry trade will continue. Ultimately, the carry trade is more than just a financial strategy. It's a moral statement about what our modern financial system values. It tells us that debt is more profitable than savings. It shows that speculation is rewarded more than production. It is a system built to extract value from the real economy and from ordinary people and funnel it into a financial casino where the house, the big banks and institutions, always wins. It privatizes profits for the few while socializing the losses for the many. This isn't a flaw in the system. It is the system, working exactly as it was designed. Understanding the carry trade is the first step to demanding a fair, more stable financial world for everyone. Thank you so much for watching. If this video opened your eyes to how the world of finance really works, please hit that like button and subscribe for more content that breaks down the big economic issues. Let me know your thoughts in the comments below. See you next time.